And welcome to this first webinar of 2025, given to you by Harts. And we have a whole series of webinars got arranged for you for the new year. So just watch out for those. There'll be plenty of more coming. And let's see what we've got booked for you for this year. Well, let's start off with our usual disclaimer. The following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. And just so you're aware, for anyone who's not joined us previously, we have a whole load of other resources available for you. And we can follow us on LinkedIn at Harts Limited. We have stuff going out to you every day, useful tips and tricks which you can use in your business, and general information which I think you will find very useful. So please feel free to follow us on Harts Limited on LinkedIn. You've also got a YouTube channel where we have records of the last nearly 5 years worth of recordings now on a whole host of different topics. So please feel free to go and have a look at all of those as well. Just go to YouTube and search for Harts Limited. And you can also follow us on X at Harts Accountants. And we also are on Spotify because we have a number of podcasts there, and we intend doing some more podcasts over the next 12 months or so. So watch out for those. But you can listen to us on the way home in your car, or if you've got a spare half hour, and listen to some of the fascinating stories that some of our clients and other non-clients have been in discussion with us about. So all sorts of stuff there. The next events we have on Wednesday, the 2nd of April. Our next webinar is going to be on making tax digital and a spring statement update. More about that later. We can come join us for the business club on the 19th of March at Hollin Hall Hotel. It's networking, lunch and speakers, and it's well worth coming along to. We normally have about 50, 60 people there. And it's joined with the North Cheshire Chamber of Commerce and Orbit Development. So well worth coming along. It's very reasonably priced. Just go to our events page and you'll be able to book on for that one. Just a couple of updates before we get into what we're actually doing, what's the actual topic for today. So we have the national insurance changes coming in from April 2025. You just need to be aware of these. These are all announced in our budget. If you missed anything on that, our budget webinar is on our YouTube channel. You can catch up with that. So you just need to be aware that there are a number of changes in relation to this. So you're going to be hit by an increase in national insurance charges for running your business. The thresholds have changed and the percentage has changed. You want any details, or you want a calculation of how this potentially can affect you, then please feel free to get in touch and we'll be able to help you out with that. The next one I thought I'd just mention today as well, because I was listening to the radio on the way into work this morning and it reminded me, so I thought it'd be useful to remind yourselves as well, about the expensive car supplement coming in from April 2025 for electric vehicles. Now, if you bought an electric vehicle, you're going to be subject to this from April 2025. And it's the luxury tax. So if you've bought an electric vehicle which has cost more than £40,000, then you're going to be subject to an additional supplement. And for cars costing, the current supplement is £410 a year. And this is going to be on top of your new vehicle excise duty, which is coming in. So potentially this is going to rise as well. From April 25, the expensive car supplement will rise to £425 a year. And the standard VED rate is rising to £195 a year. So if you've got a car worth more than £40,000 when it was new, you're going to be paying another £620 a year. Don't shoot me, I'm only the messenger. So just bear that in mind. And it runs for 6 years. It runs from year 2 to year 6. So potentially that's an extra £3,100 over 6 years. yeah, a little sting in the tail for those of us who have bought electric vehicles. And finally, Making Tax Digital is back on the agenda. This looks like it is coming in 2026. More details in our next webinar in April about this, but you need to be preparing for it now. If you aren't running a system which is MTD compliant, then you need to be looking at how you can change your system so it does become MTD compliant. But again, a lot more of that in our next webinar. It's been kicked into the long grass so many times. We think this is the time it's actually going to happen, but that remains to be seen, but you have to prepare for it. In essence, that's all I've got to say for the time being. I'm now going to hand over to Chris Bentley, who's our Tax and Forensic Director here at Harts, and he's going to talk you through the inheritance tax problems you didn't know you had. So tractors at the ready, if you've got one. If you fancy driving down to Westminster and demonstrating with the rest of the community, then great. If you haven't got a tractor, well, what can I say? So over to you, Chris.
Thank you very much, Stephen.
Just need to share your screen.
Can you now see the slideshow? Can you now see the slides?
No, not yet. There we go. And just click from beginning.
From beginning. Brilliant. Right, so thank you very much, Stephen. Just to introduce myself, Chris Bentley, Tax and Forensics Director here at Harts. And today we're going to have a look at inheritance tax problems. It's really the budget changes last autumn. There's a lot of noise, there's a lot of appreciation that farmers are badly affected. From talking to clients, I think there's increasing appreciation that others might be affected, but I don't think there's really appreciation of quite how big a change some of the tweaks that, as Rachel Reeves put it in October, are, and how much it will affect business owners in particular. So I'm going to run through some of that. That's very much the focus of today's webinar. It's to let you know the problems that might be there and start thinking about what you might look to do to try and defray those problems. The only good bit of news here is that the tax changes don't come in until April 26 and April 27. In other words, you have a bit of time to do things. You don't need to rush off this webinar and make a decision immediately. That would be a bad thing to do. The correct strategy is to work out where you want to get to ultimately, and then to put the structuring in place to give yourself a tax efficient route to that, or as tax efficient as possible. The tax is very much the tail of the dog, which is working out where you want to get to. So I would stress with all of this, well, there's an awful lot to think about, that you need to work out where you want to get to as a family with your estate, and let the tax run off the back of that, and not get too emotive about the tax changes, huge and horrendous as they will be to some people in their estate.
Chris, you've got on mute. There you go. You unmuted yourself?
Yeah.
Yeah, it's fine. Just need to reshare your screen.
And hopefully, can you now see it, Stephen?
Yeah, it's the different one you need to show.
Oh, it's not the right one that's sharing.
No.
Sorry about this, everyone.
There we go.
That's right, thank you. So the disclaimer is up. Stephen has mentioned it once already, but I'm going to read it through again because a lot have joined since that point. That the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of our affiliates for any action taken or any decision made to refrain from action by the attendees of this presentation. So, moving on to the real subject matter, inheritance tax changes don't just affect farmers. The farmers are in London, other people aren't. The farmers have realised, other people might not have realised. So, the farmers are in London because agricultural property relief has been curtailed. Agricultural property relief is a relief from inheritance tax that effectively exempts farmland and assets used in farming businesses. There is a parallel relief called business property relief that exempts the value of most trading businesses from inheritance tax, or effectively exempts it. That has been similarly curtailed. Now, what that means in practice is that business owners need to look at succession planning differently, and also look at managing exposures to inheritance tax. The other big change that was announced in the budget was a change to defined contribution pension schemes. Since they abolished the lifetime allowance, and indeed since they were all flexible drawdown about 10 years ago, they've actually been quite useful as inheritance tax planning vehicles, because you could put money into them and when you died it fell outside your estate. So even if you weren't intending it as a pension, it was still an inheritance tax planning vehicle. Now the government's cracked onto that one, and they're coming into the estate from April 2027. The devil, of course, is in the detail, and because there's no grandfathering of the position, you've effectively got some retrospective taxation as well. We'll come and have a look at that further on as we work through it, the webinar. So in terms of today, I'm going to take you through those key areas in a bit more detail. We're going to look at some examples of where these tax changes might cause problems, and then we'll consider some things you might want to do to mitigate those, or consider doing to mitigate those. I would stress, though, that there is no right or wrong answer, and every family situation will be different. Key bit is to work out where you want to get to ultimately with the business, with the pensions, and then we can work back from there. So, agricultural and business property reliefs. At the moment, you get 100% relief to an unlimited amount for agricultural property or business property. So provided that you have a trading business, that business should qualify for relief should you die unexpectedly, or indeed even if that's your succession plan to pass it on to the next generation. The reason it says most trading businesses should qualify is that investment companies, property companies, they are excluded. There's also an exclusion for investment assets in a trading business. So if you've got a trading business, you think, let's put a buy-to-let portfolio in there, that will affect your business's entitlement to business property relief. The revenue will also restrict you if there's excess cash. So if you're pooling far more cash than the business will ever need, there's a restriction there. But that's going into the technical side of things rather than the broad principles which we want to discuss today. Now, from April 2026, if you die, then the relief is no longer unlimited. The first £1 million in your estate that qualifies for agricultural property relief or business property relief will still get 100% relief, so effectively falls outside your estate. However, any value beyond that is only going to get 50% relief. What that means in practice is that you've got an effective debt of 20% on businesses and farms worth more than £1 million. If you're a business or a farm that falls into that category, that could have major consequences for your business on an ongoing basis. Can it even survive? Farmers are particularly badly hit because there tend to be few assets outside the business. The land, the house, they're all in the farm. The machinery, it's all in the farm. Historically, could be passed on completely tax-free. Now there's a tax problem. And to make it worse for farmers, farmland doesn't generally produce a huge income each year based on its value. So actually settling the inheritance tax bill is very difficult. Farmers are acutely affected. That's why the tracts are in Westminster. But it's not just for farmers, as we'll come on to see. It'll be significant for many of our clients, many business owners, particularly if the business is significant compared to your other assets. So the other one is the defined contribution pensions. These will fall into your estate if you die after April 2027. There's no grandfathering of pensions built up under the old rules. So if you have been merrily putting your 40 or your 60,000 more recently into pension, thinking, you know what, I don't care if I don't spend this because if all else fails and it's inheritance tax shelter, unfortunately, that planning you've done in the past is no longer effective in the future. I'm assuming here that you want to survive till April 2027. Because there's no grandfathering, the rules changes are effectively retrospective. They will also, if you die over the age of 75, give rise to double taxation. That is, there is inheritance tax on the pension pot at 40%, and then if your heirs need to get the cash out to pay the income tax, to pay the inheritance tax bill, there will also be an income tax charge on withdrawal. That could be 45%. If we put those two together, we end up with an effective 67% tax rate. There's also,
I think it's a bit of a nasty, that one, for everybody. So again, we're not saying do anything rashly at the moment, but just have a think about it as to how we can actually do it. But back to you, Chris.
And as Stephen says, that is the key to this. It's planning. You've got 2 and a bit years to plan. Don't rush and do something rash that you may then repent at leisure. There is still a consultation going on with the pension companies about how this will work in practice. The reason for that is that the pension isn't actually your money. It's in a trust. How is the nil rate band going to be apportioned between the estate and the pension? The beneficiaries of the pension fund might be different people to the beneficiaries of the estate. There's all sorts of practical problems that need to be thought through before anyone can actually do this. So I'm just going to go through a few examples. They're designed to be illustrative but believable. So I can see within the people on this webinar, don't worry, I can't see you all, or amongst our client base more generally, all of these scenarios coming up quite realistically. I don't want people to get caught up on the numbers here and how we've arrived at the numbers. We're comfortable the numbers are correct, but the real value in these examples is actually showing you what a change there is, as opposed to working out how we get to those numbers. So my first example is I've got a married couple. They're 72 and 65. They've got adult children, no previous spouses and no overseas considerations. So I'm deliberately having a nice, simple family situation because we want to keep as much complexity out of this for these illustrative examples as possible. What have they got? They've got a house. Well, let's say start from the biggest one. We've got a business. It's done very nicely. They're still working in the business. They enjoy it. It's valued at 5.6 million. They're a couple who've always put everything they've got into the business. They live in a modest house valued at 300,000, and they've got savings and investments valued at 100,000. No significant liabilities. There's no pension pots. They decided 20 odd years ago after Equitable Life that they didn't trust pensions, so they never did that. The business is the pension. It still pays them a nice income. So the total value of the joint estate is 6 million. And under their wills, all assets go to the spouse on the first death, all assets go to the children on the second death, and neither half of the couple's done any lifetime gifting. They've never really considered inheritance tax. They've got on with running the business, and that's what's made them tick. So something happens, they both get ill, and they both die during the course of this year. Inheritance tax position. The value of the business, the 5.6 million, is covered in full by business property relief. We've got 400,000 on which inheritance tax is potentially payable. That's the house and savings. But between them, there's 2 nil rate bands available. Obviously, one half of the couple goes before the other. 325,000 each. Let's say husband goes first, wife dies a couple of months later. Wife can use husband's unused nil rate band, 650,000 available. There's no tax payable. A good result for the children. Business continues unaffected, and the children can work out what to do next. Let's roll forwards 12 months. The unexpected illnesses, the deaths happen 12 months later in the summer of 2026. The couple haven't done any planning. Their wills still remain as they were. Everything to the spouse on the first death, and then everything to the children on the second death. And no one's done any lifetime giving. The inheritance tax position now looks very, very different. The 5.6 million that the business is worth, the first million gets 100% relief from business property relief. The remaining 2.3 million is subject to tax at 40%. So I've now got 2.7 million that is subject to tax at 40%. So that's the 2.3 million that's taxable, plus the house and the savings. And my nil rate band, though, is still only 650,000. What that means is this couple dying 12 months later have now left their children with an inheritance tax bill of 820,000. Summarise that. Both parents die before April 26. No inheritance tax payable. Children receive the business and full 6 million estate. Absolutely. Both of them die after April 26. No changes to wills or to planning. There's an £820,000 bill there. Settling that liability is going to require all of the savings and the house, and the children have still got to find another 420,000 from somewhere. Might be able to come from the business, it might not be able to. This is the problem many farmers are finding themselves in, because there are generally few assets outside the farm. But as I've hopefully illustrated there, it's not just farmers who are affected. If that's your asset profile, in terms of the business value and what you've got outside it, you're in the farmer position.
Chris, we've just had a quick question that's come in.
Yeah.
Does the SIP survive as a tax-free wrapper?
No, because it's a defined pension contribution scheme. One of the later examples I've got, there's 3 here. The third one will illustrate the SIP. So my next example is the younger couple and unexpected deaths. And this is why everyone really needs to be thinking about this at whatever stage of life if they've got a valuable business. So next couple, married couple, both aged 47, 2 teenage children. Again, keep things simple, no previous spouses, no overseas considerations. They're doing well. The house is valued at 700,000. They've got 100 grand of savings and investments. They've got the business held 50-50. That's valued at 3.4 million. And there's still a mortgage outstanding on the home of 200,000. So the total joint value is 4 million. You can see I've chosen the numbers to make the arithmetic easy here. Again, the wills haven't really been considered any detail. They put them in place a few years ago when the children were tiny, the business was much smaller, and everything was really about making sure that there were guardians appointed for the children. So all assets go to the spouse on the first death, to the children on the second death, and there's no lifetime gifting by either half of the couple. So again, very believable situation. Now, the parents were involved in a car crash this year. Unfortunately, one dies and a few weeks later the other die. Now, inheritance tax position here is the value of the business of 3.4 million is covered in full by business property relief. And I've got an estate that's potentially subject to inheritance tax of 600,000. That's the house, 700, the savings, 100, less the outstanding mortgage of 200, so a net 600. This couple, they've each got their nil rate bands, 325,000 each, 650,000 available. In this situation, okay, because of the children's ages, inheritance tax probably isn't the biggest concern, but there's no inheritance tax payable. So we don't need to worry about it. However, let's roll forward, and the accident that ultimately leads to both parents' deaths now takes place a year later in the summer of 2026. No one's done any planning and the wills remain as they are. I've now got my business property relief at 100% on the first million of the business, but that leaves 2.4 million, which gets 50% rather than 100% relief. So I've now got 1.2 million subject to tax at 40%. My estate subject to inheritance tax is now 1.8 million, not 600,000. That's the house, the savings, less the mortgage, plus 1.2 million of the business. My total nil rate band available is 650,000. I've now got, having rolled forward, an inheritance tax bill of 460,000, whereas previously it was nothing. So in summary, what does that mean? Both parents die now or before April 26, no tax, and the children will, on coming of age, receive the full estate. But if the parents both died after April 26, without any planning or changes to their wills, there's nearly 500,000 of tax payable. So unless there's another source of cash, for example, insurance policy, settling the liability is going to require all of the savings plus the sale of the house, with more than half of the proceeds being required for tax. And the children, or probably their guardians, are left with a business and around 150,000. Now, if that money was then needed to look after the children, is the business profitable? Can the executors sell it for an appropriate amount? Are they capable of running it? Are the management in place? You can see how that's going to could potentially cause a real problem for looking after the children of these unfortunate parents. So what I'm going to say is some businesses and families might be less affected in that situation. Some would be worse affected with the tax liability consuming all of the assets other than the business. So people at all stages need to be thinking about this if their business is worth more than £1 million. Can
I just mention something as well?
Yeah.
It's all about making sure you do have, when you're doing your wills, getting a decent, proper valuation of your business prepared, so you can at least then look at what the potential liabilities are. That is something that we can help with, whether we do this internally or not. But we do valuations for businesses, but it is something now which should be considered a lot more seriously than previously, as to getting a decent valuation of your business, so you can actually build that into your will.
And it will also, how serious that valuation needs to be will depend on the size of the business, and also how you're planning to manage the inheritance tax liabilities. If it's insurance, you need to make sure you've got enough insurance in place, for example, which means you need to have a realistic value of the business and to keep that up to date. So my final example is now going to bring in the pension. So the pension could be in a SIP. It could be in a company scheme. It could be any pension that you've set up other than final salary scheme that dies with you, and any dependents pension goes to your spouse. So again, I'm going to keep it simple in terms of the family situation, in that there's no previous spouses and no overseas consideration. I've got a married couple. They're both 73. I've chosen that age carefully and have adult children. Their assets as at today, and again, they're all held jointly. House valued at £500,000, savings and investments of 300. The family business, they might not be working in it. They might have sat back, but it's still in their hands. That's 3 million it's worth. And each of them have got an untouched pension of 600,000. So no significant liabilities, perhaps not unsurprising at this stage of life. So the total joint value of the joint estate is 5 million, of which 1.2 million, 2 lots of 600,000, is in pensions. So the assumptions here is a half share of the house goes to the children on the first death. They've done a bit of thinking about their will planning, trying to keep the house out of the hands of councils and care homes and things like that. Bit of trying to protect the residents' nil rate band. All of the assets go to the spouse. And then on the second death, all remaining assets go to the children. And there's no lifetime gifting by either half of the couple. So a couple of heart attacks or whatever, and they both die unexpectedly during the course of this year. Inheritance tax position is the value of the business is covered in full by business property relief. The pensions are outside the estate. So the estate that's subject to inheritance tax is 800,000. The house, 500, and the savings, 300. Now, the way their wills are constructed, they've got 2 nil rate bands and 1 residence nil rate band available. Total 825,000. Result, no inheritance tax payable. They're both 73. The pensions can be drawn completely tax-free, as both have died before the age of 75. Roll forward 2 years. They both died in the summer of 2027. No change has been made to the wills, no planning undertaken. I've now got pensions inside the estate. Both halves of the couple leave more than 2.35 million on death. The residence nil rate band has been lost. My total nil rate band available, I've now only got 650. Business property relief is available on the first million of the value of the business at 100%. 2 million is at 50%, so a million is subject to tax at 40%. The estate subject to inheritance tax is now 3 million. That's the house, the savings, the pensions, and 1 million of the business. So the total inheritance tax payable is now 9.4 million. Sorry, not 9.4 million. Bit of an error there. 940,000. That really would be a problem. 940,000. So, and just to rub salt in the wound, both parents have now turned 75. So the pension withdrawals will be subject to income tax at the children's marginal rate when the money comes out of the pension. So in summary, if both parents die before April 26, no inheritance tax payable, children receive the full 5 million estate. If they both die after April 27, no planning or changes to wills, I've got a £940,000 bill. It'll take all of the savings and the investments and the majority of the pension savings once income tax has been taken into account on withdrawal to settle inheritance tax liability. A very, very different situation to what we see today. So, big problems. What might we consider?
We've just got one question, Chris. It's come in. In both examples, you mentioned that the house would have to be sold to pay the IHT, but you actually need probate to sell the house, and you can't get probate until the IHT is paid.
You can usually get probate once you've got accommodation with the revenue, in terms of agreements and a plan to pay, but that might involve borrowing money.
So it's another sting in the tail, really.
It's another sting in the tail. It's also the case that inheritance tax on BPR qualifying assets should be payable over a period of time in instalments under the rules that operate at the moment. No one's done that for years and years and years because there's very few assets that are currently at 50% business property relief. There are one or two, very, very niche at the moment, but it's likely to become of much wider application in the future. So things to consider. As I say, none of these are a simple answer for everyone. You can't just go out and buy a product from your accountant solicitor to fix this problem. It's really a case of working out where you want to get to and how to get there tax efficiently. So the key one is actually looking at revising wills and succession plans. This is rescuing your agricultural and business property relief. The reason I've said less reliance on the spouse exemption is that as things stand, while your surviving spouse can inherit your nil rate band and residence nil rate band, they can't inherit your 1 million allowance for business property relief or agricultural property relief. So actually passing £1 million of business, a proportionate share of the business to the children on the first death, or into a trust, for example, on the first death, is a way to ensure that you get 2 bites of £1 million. And if you can pass on £1 million on the first death and £1 million on the second death, that is a minimum £200,000 saving. But it adds complexity. And do you want to be in business with your children? What's the proportionate shareholding? Questions for you, not for us, those bits. But getting a double bite of the cherry through the structuring of your wills would be a big saving if you can achieve that. There's also considering lifetime succession to the business rather than your children succeeding you in ownership on death. So if you're 60, 70 of retirement age, do you move the business on to the next generation now? Whereas previously you would have said, I'll keep hold of that till death. It's tax privileged. It can pass to them. I've got control of it and I can draw an income till then. Do you revisit that decision and look at passing it on now with a view to surviving 7 years? It's also worth saying that lifetime succession doesn't have to be an all or nothing. Of course, there's an intermediate, pass on 20%, 30%, 50%, 70% now and look to survive 7 years. And actually, another thing that's worth considering is that even a deathbed gift can rescue the resident's nil rate band. So even if you're 80, 90, it might not be a case of assuming that all is lost. There may still be some things that can be done to improve the tax efficiency of your current structure. The other thing that may be worth considering is settling a trust pre-5th of April 2026. The reason for settling pre-2026 is there are lifetime inheritance tax charges on assets placed into trust. But until April 2026, you've still potentially got 100% business property relief on businesses that are placed into trust. After that date, it's 100% relief on the first million and 50% thereafter. So there would likely be tax payable after 2026, but it's another thing to consider. If you're in a position where you don't want to do lifetime planning, you can't completely manage it under your wills, or you're of an age where the risk of not being here in 7 years' time is significant, or indeed, even if you're the younger couple in my example, how would you manage the tax liability in the event of an unexpected death? The younger couple here is a good example. They're not going to be passing that on to their teenage children. Chances of them going unexpectedly at 47, both of them, it's remote. But if it happens, how are we going to deal with that? So one possibility is having insurance policies in place. Life assurance, term assurance to pay to cover a gift should tax arise if you die within 7 years, or to provide a lump sum to pay the estimated inheritance tax should you die unexpectedly. That's one for an insurance broker financial advisor to sort of go into the details of whether that's appropriate for you, but it's something to consider. If there's cash within a company, that can be used to repurchase the company's own shares to fund an inheritance tax bill tax efficiently. Not something people have needed to do for a number of years, but the provisions are still there. So that might be another possibility for how it might be managed. And then, of course, as Stephen brought up in the previous question, it may be possible to manage that unexpected liability by paying the inheritance tax by interest-free instalments. That's more likely to be the case if you've got a nicely very cash generative business. The farmers are probably still going to struggle with that one. So things to consider around those reliefs. Around pensions, as I've said already, consultations are ongoing as to how the inheritance tax liability will be managed in practice. Who gets the nil rate bands? Is it the pension? Is it the free estate? Is it apportioned? How do the pension trustees have to deal with this? When people don't know the value of the outside estate, how's it dealt with? We just don't know at the moment. The message from financial advisors is don't rush. Don't rush. We've all heard stories of people that have done things with their pensions and then repented at leisure. Don't rush. Talk to your financial advisor about your wealth planning generally, and remember you have got 2 years to look at this as well. Things that people are considering though is the withdrawal of the tax-free lump sum. Reason for that is comes out of your estate tax-free, comes out of your pension tax-free at the moment. If you don't need that, you can look to give it away and hopefully survive 7 years. If, however, you die over the age of 75, then your heirs can't take that amount tax-free. So you've put it into inheritance tax and you have also got income tax on the way out. So taking the tax-free lump sum is something a lot of people are looking at. Increasing your lifetime withdrawals from the pension coupled with regular gifting out of income. Regular gifting out of income is something that is immediately exempt from inheritance tax. So that might be a way to move assets onto the next generation. Some people are even considering annuities at age 75. Gambling on your life expectancy, talk to your financial advisor, not to us if you're thinking of an annuity, because that's a financial advice decision, not a tax decision. From a tax perspective, it's reconsider what assets you should be drawing down first. Historically, we've said from a tax perspective, draw down anything that's not tax privileged, then take your ISAs, then look at your pension. And it's all to do with how they're taxed. Going forward, is that necessarily the best approach? It's going to be a much more balanced decision in line with your financial advisor, who is going to tell you, well, that's invested in X, that's invested in Y. Perhaps you might want to bring those down from an investment perspective. The other thing to think about is we've got a lot of people at the moment who are talking about going overseas. And I think in a lot of cases, it's more than idle chatter. If you are considering going overseas, yes, there's a long tail for inheritance tax purposes before your worldwide estate falls out of UK inheritance tax. But if you're in your 60s, you may well manage that 10-year tail that we're expecting to see. Can your pension also be taken out of the UK too? So if you're outside the UK and your pension's outside the UK and you've gone to somewhere where there isn't inheritance tax, that can bring the pension outside inheritance tax. Complex area, a lot of thought needs to go into that one, and it will depend on a jurisdiction by jurisdiction basis and your wider planning. But if you are considering moving overseas, think about the pension as well. So it's also now makes us think, well, how should we be using pensions? They're no longer inheritance tax planning vehicle in the way they have been. The public sector can continue as they are because it's all, or pretty much as they are, because it's all defined benefit schemes. There will be a few who've got an unmarried spouse who gets a dependent's pension, and they do need to be concerned because it can't pass to the unmarried spouse. That would also be potentially be caught up. but most defined benefit schemes aren't going to be a problem. Are pensions still valuable? Probably yes, for the income tax reliefs and tax deferral. It's a good way to get money out of your company tax efficiently, spend it in your years to come when you're paying tax at a lower rate. Tax deferral, tax-free investment while it's in there. Probably yes. Don't throw the baby out with the bathwater because you've lost the inheritance tax shelter, but it is different to, it's not where it was previously. And as I would say all the way through with pensions, really would stress that pensions aren't just a tax matter. They need to be, they're a financial matter. They need to be reviewed in conjunction with your financial advisor, or purely yourself if you're doing a financial advisory yourself. It's not just tax. We can't advise on the investment decision. So finally, to summarise all of that, the answer will be different for every family in terms of what you should be doing and what you should be looking at. What's right for you will depend on your personal and family circumstances. But what everyone might need who is affected will want to be thinking about is reviewing wills and your pension expressions of wish. Perhaps less reliance on the inheritance tax spouse exemption. Which assets should pass to the spouse on the first death? Not so obvious now. You might want to be passing more to the children on the first death because business property relief in particular isn't inherited by spouses. Also, review your business succession planning. Is it necessarily still the case that the business should be passing to your children on the first death? Lifetime gifting has become more attractive. But the problem with lifetime gifting is that what happens if one or more of your children gets divorced? Do you want a spouse to disappear off with part of the value of the business? Probably not. Can't do much about it after you're dead, but during your lifetime, you potentially can. So perhaps greater consideration of the use of trusts and possibly also prenups as asset protection strategies. When you get to retirement age, thinking more about which assets should be spent down first. You can't take it with you, your wealth that is. What should you be keeping? Because you want to be whittling it down, because the more you leave on death, the more the Chancellor gets. What assets are you spending first in retirement? And if all else fails, and you're the unlucky couple in my second example in particular, or you're the farmer or the business owner who's late 70s, 80s, trying to give things away now, how would the inheritance tax be paid in the event of your death? What have you got in place to do that? All of these things need to be thought about and considered over the next year or so, next 2 years for pensions. And to build up a plan and what you've got around that to help going forward. I think that then brings us to the end of this webinar. As Stephen said, our next webinar is on the 2nd of April. Probably going to be on Making Tax Digital and the Spring Statement. The balance will, I think, depend on how much is announced in the Spring Statement, but that is the plan at the moment. So we look forward to seeing you on that one, and I'll hand back over to Stephen.
Yeah, thank you very much, Chris. We've got a couple of questions come in. You mentioned the company purchase of own shares to pay. Can that be done post-death, or must that be done pre-death?
I'm thinking about it being done post-death. Without at the risk of going technical on this, company repurchase of own shares is usually taxed as a dividend. It can be taxed as capital gains in two circumstances. One is where it's essentially the buying out of a reluctant shareholder for the purposes of the trade in a trading company. And there are quite lengthy holding periods required for that one. The other one is actually if the repurchase is to fund an inheritance tax liability. Now, no one's needed to do that for a good number of years, but it's one of those exam questions and it's still there. That possibility remains there. because you get a capital gains tax uplift probate value on death, if a company repurchases its shares shortly after death, quite often there'll be nil or no capital gains tax in there. So it might be a way to get it out. But what I would say, before you leave cash in the company, excess cash in a company is going to be subject to inheritance tax at 100%. It doesn't qualify for business property relief. So it is a bit of a double-edged sword, that one.
Okay, thank you. Has anybody else got any questions? I know we've had, this one's coming again. Does the SIP survive as a tax-free wrapper? It does as a tax-free wrapper whilst it's in existence, but not for inheritance tax purposes. So yeah, you'll still get your tax-free growth and income within the SIP tax-free, but then the value will be subject to inheritance tax depending on your circumstances. Anybody else got any questions? You can please feel free, if you want to, you can unmute yourself and shout out. If anybody else has got anything, you can put them in the chat box. It's in the top of your screen. Just stick a question in there. I know there's a lot of nasties in here, and it's all subject to, some of it's subject still to consultation on how it's all going to work. And it's not due to come in until April 27.
April 26 for business
26,
agricultural beneficiaries, April 27 for pensions.
Pensions, okay. So there's still time for things to change. Whether that will actually happen or not, we just don't know. Now, no doubt there are going to be schemes and people offering all sorts of stuff out there. Just be very careful if you come across anything. I mean, one of the wheezes we've come across is actually you divorce your wife and you marry your mother-in-law, and that's the way of getting around some of the estate down into the other generations. I'm sure that's not going to apply for the vast majority of people, but just a bit of joviality at the end of a very serious and taxing webinar. Has anybody else got any questions that they want to raise? If not, let's call it a day there. This has been recorded and will appear on our YouTube channel later on today. So if you missed anything and you want to go back onto any of the questions or examples or so on, then please feel free to go onto our YouTube channel at Harts Limited, and you'll be able to visit the webinar there and rerun some of the slides and so on. If you want a copy of the slides, if you let me have your email address, again, we'll be able to send a copy of the slides over to you. But all that remains to me is to say thank you very much for joining us this morning. If you enjoyed it, please tell people how wonderful this webinar has actually been. We look forward to seeing you either at the Business Club lunch in March or on the next webinar on the 2nd of April. Thanks very much indeed, and have a great day.